The real question is, where are we going to be a month from now? A month from now, after it's resolved, then where are 2-year rates? My guess is they may be a little higher. There's risk premiums in everything. Risk premiums in gold, risk premium in stocks, risk premium in rate structures, because we're all terrified of the debt ceiling. So if those are gone, stocks are probably a little higher, gold's probably a little lower, rates might be a touch higher because those risk premiums will disappear. So you have, that's the very shortest term. I think you'll have some kind of indigestion along the way, and yes, I'd buy that. Then we have, in a more intermediate basis, we have the financial cycle. The financial cycle, which is what we kind of look at internally, is the combination of the historical debt and asset valuation boom bust.
Right.
So if you think about post-COVID, we had this massive increase in debt, massive increase in equity valuation. It creates this boom in the financial cycle. That's happened in 1990, that happened in 2000, that happened in 2008. Our financial cycle, the peak of total debt growth plus stock market valuation, occurred in September of 2021. I think, again, if I just think about this year and I think about 06, 07, 08, it doesn't mean that the stock market cannot go higher as the economy decelerates. If you just think about it, if that was the last hike that we just had, the playbook's real simple. 6 months from now, stocks are 10% higher. 6 months from now, interest rates are generally 50 to 70 basis points lower. There's a halcyon period post last hike where asset prices do okay. Commodities barely recover. The dollar kind of does nothing. This banking crisis, it's troubling to me because we just killed 3 big banks. And when I say we, I think bad monetary policy combined with bad fiscal policy created a situation that never had to happen. We knew in the fourth quarter of 2020, it was so obvious we were going to have a vaccine, but we continued with quantitative easing for an entire year after that. And the whole time, we're telling everyone rates are going to stay low forever. Inflation is not an issue. We're trying to get inflation above 2%. The banks, anyone that was listening to our Fed at that point in time was probably doing exactly what these banks did, extending maturities because they were being told that inflation didn't exist when it finally did come as transitory and rates were going to be low forever. We did not have to have all that overstimulus. And then all of a sudden we found out inflation wasn't transitory. They had to course correct a over-exaggeration of what they were doing in 2020 monetary policy.
Jones likens the debt ceiling issue to kabuki theater that may cause short-term market volatility, suggesting that once the debt ceiling is resolved, risk premiums may disappear, leading to potential increases in stock prices and interest rates. Looking at the financial cycle, which combines historical debt and asset valuation booms and busts, he points out that historically a 2-year lag between peak debt growth and stock market valuation and a subsequent recession occurs. Based on this pattern, he suggests that there is a good chance of approaching or entering a recession in the third quarter of the current year. Despite the possibility of a recession, Jones suggests the stock market can still perform well as the economy decelerates, presenting a scenario where 6 months from now stocks could be 10% higher and interest rates could be 50 to 70 basis points lower. Jones expresses concern about the banking crisis, attributing it to bad monetary policy combined with bad fiscal policy, suggesting that the Fed Reserve continued quantitative easing and low interest rate promises even when inflation was expected contribute to the crisis, highlighting the need for course correction and re-evaluation of monetary policy actions.